Hello, my name is Elliot Gu, and I'm editor and co-founder of CapitalistTimes.com. Today I want to talk about one topic that I've heard a lot about over the last few weeks and also heard a lot about from subscribers to my premium services and a lot of questions about, which is really oil prices. Crude oil prices have tumbled so far in this fall from highs well over $100 a barrel, around $108 a barrel for West Texas Intermediate crude oil over the summer. Down to the mid 70s. I hear a lot of people out there, a lot of pundits out there talking about oil prices heading higher again, and therefore seeing this as a buying opportunity for a long list of energy stocks. And as many of you are aware, I disagree with that view, and I actually think that there's a good chance that we'll see crude oil prices in the 50s. You heard that right, in the $50, $55 a barrel area at some point over the next 12 to 18 months. And I want to set up exactly what I see fundamentally going on with oil prices right now. The first chart here really just is designed to back up and take a 30,000 foot view of the energy markets and oil prices. Now, I've been studying the oil market for many, many years as an editor and writer for a number of different energy-focused publications. And so you might actually be surprised to hear this from me, to hear the idea that oil prices are heading down, and that I think that a lot of traditional energy stocks are not a great place to invest right now. But it's really silly to deny the fact that the oil industry, like a lot of different industries out there, is cyclical. Prices do rise, and they go through lengthy periods of rising, and they do fall. And we've actually seen several cycles over the last 10 years, and it's absolutely nothing to be afraid of. But in 2002 up until 2008, mid-2008, we saw energy prices, oil prices, and natural gas prices in that cycle generally rise. It was a very prolonged cycle. Prices went a lot higher than many people thought they would ever see again. We actually saw, in some parts of the world, crude oil prices touch almost $150 a barrel at their highs in 2008. Obviously, the second half of 2008 and the first half of 2009 was a bear market for energy prices. Oil prices went down, and so did most energy-related stocks, also due, of course, to the financial crisis that was going on at exactly the same time. And this very basic cycle chart that I've put up on the screen here gives you an idea of what happens in an energy price cycle. So let's start with the lower right-hand side of this chart, which is when oil prices are low and generally weak or falling. A good example of when this was happening would be back in 2002, or more recently in 2009, early 2009. So what happens in the energy business when oil prices are low and falling is that energy companies spend less money on exploration and production of crude oil. So capital spending, or CapEx, slumps. Companies doing drilling in the deep water, doing drilling onshore as well. Companies involved in actual production of oil and natural gas cut their spending. Why spend money to produce more oil and gas if prices are low and falling? But this cut to CapEx budgets, this cut in spending and in the amount that's spent on exploration and production, tends to sow the seeds for the next rally in crude oil prices. Now, the reason for this is that if you're spending less money going out and producing more oil and gas, you're finding fewer fields, and therefore there ultimately will be a production response. And that's what brings us to the lower left-hand side of my chart here, which is that prices sort of bottom out, oil prices begin to bottom out. Often this happens because supply falls. There's less spending on exploration and production, therefore less production, less supply. That puts a floor under oil prices, and prices begin to rise. As prices start to rise more and more, you begin to see a bounce back in capital spending. Companies want to go out and spend more money to find and produce more oil, more natural gas, to take advantage of those rising prices. So as supply falls and capital spending remains weak, it takes a while for that supply to catch up with now growing demand again. Because the other thing that low oil prices do is they cause people to want to use more oil and use more natural gas. Conservation isn't very valuable when prices are low. So as time goes on, we start to move to the upper left-hand side of this cycle chart. And that's that demand is strengthening and very strong. We see capital spending pick up. We see capital spending broaden out. When companies first see rising oil prices, they tend to spend more money on development, squeezing a little bit more oil and gas out of from existing fields. As time goes on, they spend more money on exploration, higher risk projects to try to find big new fields that ultimately will generate a lot more oil and generate a lot more profit for them. But as time goes on, this high and rising price environment tends to sow the seeds for the next decline in energy prices. Why? Well, we tend to see a production response as companies go out there and spend more money on drilling and production and finding new fields. Ultimately, that means more oil out there, more natural gas out there, and that excess supply tends to put a cap on oil prices. In addition, of course, as prices rise, people want to use less oil and less natural gas, and so there's demand destruction. So the demand side of the equation also becomes a headwind and no longer a tailwind for oil prices. And that brings us to the final quarter of this cycle, which is the upper right-hand side, and that is when demand destruction due to higher prices, coupled with excess growth in supply due to all this capital spending on drilling and development, causes oil prices to begin to fall, and we start this whole cycle all over again. So obviously with a cycle like this can all take different time frames. For example, over the last few years, we've seen a prolonged left-hand side of this cycle where prices have been rising. And in 2008 and 2009, we saw a very short but very, very severe right-hand side of this cycle when prices fell very sharply, but then it only lasted for less than a year, really, of falling prices. So we kind of know where we're going in a cycle because it's a circle. But the key question is, where are we on the cycle right now? Because that's what's going to govern what stocks you should own and, just as important, what stocks you shouldn't own. I believe that we're in the upper right-hand side of this chart. Oil prices have fallen, but the downside is just beginning because supply, especially in the US, is excessive, and it's only going to get worse over the next few months. Now that's the bad news, and let me get right into that. This is a chart of US oil production, and I call this North America's Day of Reckoning, and I'll talk a little bit about that more in a while. But the first thing to note is that I took this chart all the way back to 1920, and you can see the basic trends there. From 1920 up until the early 1970s, U.S. oil production rose from a little over a million barrels a day, all the way up to over 10 million barrels a day. In the early 70s, U.S. oil production topped out and pretty much slid continuously until 2005, when it reached levels well under 5 million barrels of oil a day. At that time, a lot of people were talking about that trend continuing. A lot of U.S. oil fields are very mature, very old, and seeing declining production. So that general decline in production was expected to continue. But what happened was, of course, we saw the rapid development and commercialization of shale oil fields, like the Bakken Shale of North Dakota, like the Eagle Ford Shale in southern Texas, and the Niobrara Shale in the Rockies. And that's resulted in what you see at the very end of this chart, which is a very rapid increase in oil production. U.S. oil production has gone up by 60% since the 2009 period. We've gone from lows in the 2005 period of under 5 million barrels a day, all the way up to about 8.7 million barrels a day right now. By the end of next year, if current trends persists, we could be approaching 10 million barrels of oil a day of production, again approaching our highs last seen in the early 1970s. Right now, we're back to the mid-1980s, basically 30-year highs in U.S. oil production. So what does that mean? Well, all this new production from these ultra-prolific shale fields is causing U.S. production of oil to grow at rates that we haven't seen in really 40 plus years. So let's just look at it on the shorter term and why I think oil prices are going to see significant downside to at least the $50 to $55 a barrel area at some point in 2015 or by early 2016. So let's just look at 2015 today. Next year, 2015, U.S. oil production is expected to grow by about 1.1 million barrels a day. So supply of oil in the U.S. is expected to grow by 1.1 million barrels of oil a day. Now, that's not an aggressive assumption at all. That's just an assumption that current trends persists. Actually, oil production growth over the last few years has been at that level or a little higher. So I would say that that production growth estimate, if current trends persist, is actually a little conservative. So if oil prices are to remain where they are, we have to have a way of offsetting that growth in production. So there's all this new oil coming into the US market from these shale fields. Something has to be done with it. Otherwise, there's going to be an oversupply of oil and prices will fall. So what are the demand outlets or the trade outlets that we have for this oil? Well, next year, US refineries are expected to demand an additional 200,000 barrels of oil a day or so. The reason for that, no new refineries have been built in the US since the late 1970s, actually the mid-1970s, 1976. But existing refining capacity is expanding because US companies are spending money to upgrade their refineries, allow them to process more oil. So about 200,000 barrels a day of additional refining capacity in the US will soak up about 200,000 barrels a day of that 1.1 million barrels a day of US oil production growth. In addition, and you may have heard about this, I don't have a lot of time to go into this in this short video, but condensate exports. The US does not allow the export of crude oil, but they do allow the export of a crude oil-like commodity, which is known as condensate, which is produced in a lot of parts of the US, but particularly down in the Eagle Ford Shale area of southern Texas. Condensate can be used in a refinery, much like crude oil, or in addition and mixed with crude oil. And the US government has been allowing the export of not crude oil, but some volumes of condensate via private letter rulings from the Department of Commerce, which is an exception to the early 1970s law that prohibits US companies from exporting crude oil. So condensate exports, and I think this is actually kind of an aggressive assumption, could rise by as much as 300,000 barrels a day in 2015, so that will actually offset some of that US oil production growth. And finally, there is an allowance for some exports of crude oil to our northern neighbor, Canada. And I think that US crude oil exports to Canada could go up by about 150,000 barrels a day in 2015. Again, a little on the high side. It actually might be closer to 125,000 barrels a day, but maybe as much as 150,000 barrels a day. In addition to that, and this is not elimination of US crude, but it's an elimination of potential competition for US crude and US refined products. In Latin America, a number of new refineries that are being constructed in Latin America are going to allow countries like Brazil to process more of the oil that they produce at home and sell gasoline and diesel fuel, so refine it at home domestically, rather than exporting that oil to the US to be refined. So I think the addition of this capacity maybe takes as much as 350,000 barrels a day. Again, that's a little on the aggressive side. Takes about 350,000 barrels a day out of US supply. So if we add all those numbers up, we get no more than 1 million barrels a day. So US production growing by 1.1 million barrels a day, demand and demand outlets for this supply only growing by about 1 million barrels a day. That tips the balance in favor of supply over demand, which tends to result in building inventories and lower prices. And I actually think there are a number of factors that could exacerbate this situation. First up, Saudi Arabia. How many people out there have heard already about Saudi Arabia wanting to maintain or hold its market share? Now, what that really just means is that Saudi Arabia wants to continue exporting oil to the United States, regardless of whether we need it. And so as the US produces more oil, most OPEC countries have actually backed exports out of the US. For example, for 30 years, we imported oil from Nigeria. But in September of 2014, for that month, we imported no oil from Nigeria. That's because US refiners preferred to use cheaper US produced oil rather than importing expensive crude from Nigeria. In Saudi Arabia's case, though, what they've been doing is discounting the price at which they sell oil to U.S. refiners to try to maintain a foothold in the U.S. market of over 1 million, maybe up to 1.5 million barrels a day. Now, Saudi Arabia, if they were looking solely at economic forces, would simply sell less and less and less crude oil to the U.S. and instead sell their oil in Asia or someplace else where they can get a higher price for it. But Saudi Arabia doesn't want to do that. They want to hold their market share. Now, depending upon how aggressive they are about that and how much market share they want to hold, which lately we've been seeing that probably a little bit more than the market had expected, means that that oil could actually be forced into the U.S. market and further increase supply here in the U.S. and drive down U.S. oil prices even further. And I think that's in fact something that's going to happen. Because the other point to note is that when oil prices internationally are close to where U.S. oil prices are, you'll actually see a lot of refiners in the U.S. who are on the coasts, places like the Gulf Coast or the East Coast, will actually find it cheaper to import crude than to move oil from some place like the Bakken Shale of North Dakota to their operations. Therefore, you actually might see U.S. imports tick higher again, even though we have too much oil in the U.S., which of course will lead to a greater than expected build in inventories and even more weakness for the U.S. And as I'll talk a little bit more about in a moment, U.S. production probably will remain robust above $60 to $70 a barrel. The reason is a lot of energy producers out there in the shale can still make money at that level. And remember, these guys have rigs, they have labor, they don't want to let that go. They have acreage that they have to drill on to hold it, they don't want to let that go. So they keep drilling even when they're not making as much money as they were before. And what that means, as I'll explain in just a moment, is it will probably need a big spike lower in U.S. oil prices to actually balance this equation. The reason I say that is that U.S. oil production, if trends persist, will go up by about 1.1 million barrels a day in 2015. The only thing that could change to change that would be price, right? So if prices go down far enough that producers drill a little bit less aggressively, we won't see 1.1 million barrels a day of production growth. So we won't have as much supply to offset, and that will tend to bring the market back into balance so we don't have this build in inventories. What's going to have to change is U.S. oil prices. Prices are going to have to spike down into the 50s in order to get producers to slow their drilling activity enough to balance this equation, to balance this lever. As I mentioned, something has to give, and the only thing that can give is price. Now this chart, which I took out of the Wall Street Journal, gives some basic estimates for the break-even costs of oil production from a number of different plays around the U.S. For example, the Permian Basin in West Texas and parts of New Mexico. The break-even oil price there is somewhere around $55 all the way up to $75 a barrel, depending upon where in the play you're working. So you're still going to see production from this play even at $60 or $65 a barrel because companies can still drill profitably there. So you're still going to see growth in production from this crucial play even at much lower oil prices than where they are today, around 75. Pretty much all producers are breaking even or making money in the mid to upper 70s there. So we're going to need to see prices spike all the way down to the $50 area and stay there for at least a little bit of time to encourage producers in that region to slow their drilling activity. Also, the Bakken Shale, production costs there anywhere from $60 all the way up to $75 a barrel. Need to see oil prices in the 50s to see production growth slow there. The Eagle Ford Shale in southern Texas, another big play. $55, $65 a barrel cost. We're going to need to see prices get down under 60 into the 50s to see production growth slow from that play. So again, something has to give. U.S. oil production cannot grow 1.1 million barrels a day in 2015 because there are not enough demand outlets for that oil. The only thing that can change is price, and it has to go low enough to discourage these companies from continuing to drill at the rate they've been drilling over the last couple of years. Listen, I would not be shocked to see WTI oil prices plummet to $50 a barrel at some point over the next 12 to 18 months. Investors who continue to buy oil and gas producers stand to lose some serious cash. If you take nothing else away from this video, please understand one key point. This is not a buying opportunity or a good time to average down on many energy stocks. However, investors shouldn't fear this turn in the oil cycle. If you know which stocks and sectors to avoid, you can dramatically reduce the risk to your portfolio. I'm talking about selling some of the popular money sinks, like the offshore drillers and fracturing sand companies, right away. Just as important, there are plenty of stocks and sectors that will generate real wealth for investors thanks to falling U.S. energy prices. You see, if you know which stocks to buy right now, you can earn some serious cash today while most investors chase their tails looking for a bottom in oil prices. I'm even seeing the opportunity to lock in some tasty yields in some sectors of the energy market with little or no exposure to commodity prices. I'm talking about yields of 6%, 8%, or even 10% and higher available right now. I believe this information is so crucial to making money over the next 12 to 18 months, I've decided to offer a detailed special report absolutely free to all viewers of this video. Simply fill in your name and email address in the box below this video to receive a free copy of our special report, Hedging Your Bets, Game Plan for Lower Oil Prices. You don't have to enter a credit card number or sign up for one of my paid subscription services to get this free report. There's only one catch. Our report, Hedging Your Bets, Game Plan for Lower Oil Prices, will only be free for a limited time. And then I've instructed my team to restrict it to just paying subscribers. Act now to download our free PDF report, Hedging Your Bets, Game Plan for Lower Oil Prices, today.